We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore with Annabelle Droulers in Sydney.
Our top story is Asian stocks moving in tight ranges after a tech rally lifted Wall Street. Hong Kong and Sydney set for a shortened session for Christmas Eve.
President Biden's administration launches an investigation into Chinese chips, offering President-elect Donald Trump a choice about possible tariffs.
And Nissan shares sinking this morning after Honda unveils a deal that amounts to an acquisition of the Japanese automaker. Taking a look at the market action this morning, also taking a look at what's happening with the WVM function, and basically a lot of traders are already into their holiday breaks for the session today. We are seeing the broader Asian benchmark just moving a little bit higher. Taiwan is the latest one to come online this morning, and taking a look at TSMC shares because they've actually risen 1.4% in Taipei. That surpasses the record that we hit back in November of this year. It could be sort of that continuing reaction that we saw. Firstly, we had the local media reporting yesterday that Nvidia is looking up setting an Asian headquarters in Taipei, so that's one of the supportive factors. But broadly overnight in the session, it was tech that really led the gains, and we saw a further rally for the Nasdaq. Again, approaching the year end, we still have traders very optimistic on the outlook for AI heading into 2025. So TSMC is seeing gains there of 1.4%. Broadly, though, as I said, volumes are looking pretty thin here across the board. We've got holiday shortened trading for Hong Kong, Sydney, New Zealand in the session today. US futures fairly steady right now, but also what else we're tracking is what's happening in the automaker space. Let's take a look at what the shares of Honda, Nissan, Mitsubishi, Toyota. We actually have seen these moving quite substantially in the session so far today. Honda a gain of nearly 15% there, but tracking what we had in ADRs, of course, it is that deal sort of sketched out plans now, getting more details. What looks to be sort of an acquisition of Nissan by Honda. Of course, the deal is going to take quite a few years to be complete, but it does create one of the world's largest automakers. So it helps to fend off that competition, not from Toyota only, but also from the car makers in China. Taking a look at what happened with the Golden Dragon Index overnight as well, because we did actually see China stocks rising, the likes of Alibaba, Baidu, some of the biggest gainers there. We did also have Zeekr gaining nearly 10%. Speaking about the outlook for Chinese stocks, of course, yesterday in the session, we did actually see some of the moves really being directed by those southbound flows. Mainland Chinese investors snapping up a record amount of Hong Kong stocks, looking at further risk assets that are trading in the city, sort of a revival of animal spirits, perhaps. Of course, you've got those expectations for easing next year. But we did see traders in Shanghai, Shenzhen, buying $100 billion of stocks in the financial year this year through December 20, and that is actually the highest amount of stocks we've seen being bought since the trading link was opened, Avril, back in 2016.
Yeah, but you got to wonder as well some of the risks for the year ahead, Belle. I mean, you think about that strategic competition between the U.S. and China. How is that going to define the sort of trading in 2025? And indeed, our top story, President Biden's administration is launching an investigation into Chinese-made semiconductor chips, and it's a move that could lead to fresh tariffs. Our China correspondent, Min Min Lo, joins us from Hong Kong. So, Min Min, what's new about this investigation that involves foundational chips, not the ones that are used for advanced AI applications?
Yes, Avril, this is a scoop that Bloomberg had reported earlier. We know that President Biden and his administration has been tightening the noose on China's access to advanced semiconductors and equipments, but this current investigation is going the opposite way. It's investigating the flow of Chinese legacy chips into the U.S. And again, these are older generation chips that are used in everything from cars to mobile phones to medical devices and airplanes. And take a look at that quote from Gina Raimondo. She Ministry is saying that, look at what happened during the pandemic when the U.S. was trying to get its hands on these chips, but they weren't available. That really jacked up prices. It shows the risk of over-relying on overseas suppliers. So U.S. officials are also saying that these chips, if they're overly controlled by China, they could pose a national security threat. And by the time this investigation concludes, it normally takes 6 to 12 months. Biden would no longer be in office, so that means it would be up to President-elect Trump and his incoming administration to decide what to do with the outcome of this investigation. Trump could possibly raise tariffs, or he could impose more import restrictions, but whatever it is, it gives him yet another bargaining chip in his negotiations with China on U.S. trade and industrial policy.
So the investigation, yeah, as you say, it could take months, but in the meantime, has there been sort of any initial reaction from Beijing?
Yes, the Chinese Commerce Ministry has responded. Obviously, they are very unhappy with this. They are opposed to the investigation. But China has also pointed out the double standard that the U.S. is applying here. The Chinese statement pointed out how the U.S. is pouring in huge sums of subsidies into the Chips and Science Act to support U.S. companies, which now constitute about half of global market. The statement also said that Chinese chips only make up 1% of the U.S. market share, 1.3%. And it says that the U.S. is really exaggerating the Chinese threat here, that it is obviously self-contradictory, and China will take all necessary actions to defend its interests.
As our China correspondent Min Min Lo there, and we'll be watching, of course, how shares of chip makers in China come online at the bottom of the hour. But in the meantime, still looking at shares of Honda and Nissan after they announced a tentative agreement to set up a joint holding company, with Honda taking the lead and nominating a majority of directors. Take a listen.
Once the definitive agreement is concluded, the holding company will be incorporated and be listed on the prime market of the Tokyo Stock Exchange, subject to obtaining necessary approvals from relevant authorities in resolution at each company's general meeting of the shareholders. The visibility of the timing is August 2026.
In order to work together, we need to benefit from the huge synergies. Otherwise, it wouldn't be meaningful in the eyes of the stakeholders. So that is why we agreed to start the discussion. That is why we are making this announcement today.
But the former chairman and CEO of the Renault-Nissan-Mitsubishi Alliance, Carlos Ghosn, told Bloomberg the two firms do not complement each other and that the deal does not make sense.
There is no complementarity. The two companies are two Japanese companies. They are strong in the same fields. They are weak in the same fields. Both of them have very developed technologies. From an industrial point of view, there is duplication everywhere. So industrially, for me, it doesn't make sense.
For more, let's bring in our transport reporter, Danny Lee. And Danny, just sort of taking a very, I guess, crude analysis of this, it does seem that traders like this deal for Honda, but maybe not as much for Nissan. Do you think that that synergy has been found, even, of course, if it seems Carlos Ghosn disagrees?
Well, I think the shareholders, the share moves in particular we're seeing in Honda this morning in Tokyo, very much reflects a $7 billion sweetener, the 1.1 trillion yen buyback here. And as we see shares pop even higher, around 15% and change, but it's continuing to gather pace at the open. But then you do see on the flip side, we had Nissan down as much as 7%, but it's raising most of the losses it's made in the early trading session. And obviously we see Mitsubishi up a little bit, Toyota also a bit unchanged. But I think the very much a reaction is very much of a strong one here for Honda, given the fact that it will be taking the lead and very much in the driving seat here when it comes to putting together the formation for what will be the third largest automaker by sales here.
Danny, now that these talks towards a merger or takeover is official, what do we know about it that we didn't already know before?
I think it's just the confirmation here that we look to see an agreement, a formal agreement for a merger be finalized by summer of next year, and then a new holding company taking shape in 2026. The two companies will sit under that, and there will be a new company listed in Tokyo. But again, just the fact that the synergies that were outlined that could happen from R&D to manufacturing, sales, and finance. So, as we heard from the top, the idea of extracting a lot of the cost and synergies, and one that's going to be really important for Nissan because of the strife it's in, and then the ambition here to elevate earnings to 3 trillion yen rather. Goal. Although not quite a timeline has been put on that, it's still very ambitious, and one that, to try and elevate earnings and to try and get these car makers, which have struggled with the competition from China, to a more level playing field.
So do you think then, Danny, that this is going to be enough, this new holding company? Because, of course, Chinese car makers is one, Toyota is another. Does this really give them sort of an edge at all?
When you have the kind of the scale of this combination, you see the potential, typically of what it can become. I think clearly the difficulty around this kind of merger and the worry is that you have two very different companies, as Carl has outlined, and the idea that you can have two very proud workforces, different ideas of how to make cars. Coming together is going to be difficult, which is why the fact that the Japanese government is very much supporting this pathway forward, and clearly this combination, everything else is trumped by, for example, national security and the economy. So clearly both sides will have to try and drive for a lot in order to see the successes and the fruits of that in the many years to come.
That's our transport reporter, Danny Lee, there. And also sticking in Japan and this proposed acquisition of US Steel by Nippon Steel. We know that this is a deal that's very much been caught in the political crosshairs of the election cycle in the US this year. We had an update this morning on some reporting out from the Washington Post. And in their story earlier today, they were saying that CFIUS, which is a sort of a high-level government review board, the Committee on Foreign Investment in the United States, that they actually told the White House that they were unable to reach a deal or a consensus rather on the national security risks involved in that proposed acquisition. So that was the reporting from Washington Post earlier today. We did actually get an update just now from Nippon Steel. They're saying that they haven't actually received any sort of update from CFIUS. They are urging President Biden to reflect efforts on security as well. So a bit of an update, a bit of a response to that Washington Post reporting. We are just seeing Nippon still moving a little bit high, 1.5%, just reflecting back on some Bloomberg reporting also because we had a scoop earlier this month, and they are saying, or in our story, they were saying that Biden was planning to block the sale of US Steel to Nippon Steel on national security grounds once that decision was referred by CFIUS. But again, that is Washington Post reporting on that front. Still ahead, we will take a look at the rebound that we've seen in Chinese property stocks. We have seen sort of some recent gains. Maybe that faces a bit of a reality check next year. You're seeing those gains at least were up 7% over the course of this year. But first as well, outlook for the Fed. We've got AXA Investment Managers joining us, why they're not done with fighting inflation just yet. So Ecaterina Bigos joining us in a couple of minutes from now. And we're counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. Futures looking to fairly flat trading throughout the day. Holidays maybe have already started for some traders. This is The China Show. You're watching The China Show, taking a look at the yuan reference rate at the bottom of your screen there. So coming in stronger than estimates this morning, 718.76, the estimate for 729.93. Yuan, though, we really have seen sort of resuming declines, and it's not just a yuan story, it's also that dollar strength, and that came out across the night because we had another day of dollar gains. We've actually seen the yen being one of the biggest laggards against this, and hearing this morning from the finance minister Kato speaking in Tokyo, saying that essentially they're going to keep communicating with foreign authorities closely. There's no change in the government stance on FX, and they're also warning against these possibly excessive moves. So again, it's that story of dollar strength coming across. That's the outlook for the offshore yuan there. But Avril, it also comes down to the outlook for the US economy, and also those consumer confidence figures overnight.
Yeah, which was interesting how investors pretty much shrugged that off, right? The U.S. consumer confidence gauge fell to 104.7, and this was unexpected. Not only that, it's the first time we're seeing this in 3 months, coming in well below estimates. And I think this is just another sign of the uncertainty around Trump's administration policies, and consumers in the survey increasingly citing politics and tariffs as a concern. There was actually a special question that showed 46% of respondents see tariffs raising the cost of living. And this indeed, I think, mirrors some prior surveys where consumers had similar concerns about tariffs, including, I think, a University of Michigan poll, and that showed that there was a surge in people that thought they should be buying durable goods right now, rather than, later on in a way to avoid higher prices. So it's really about the consumer psychology, what tariffs could potentially mean for import costs, overall the cost of goods, at a time when the Federal Reserve is renewing its focus on inflation, Belle.
Yeah, that's right, Avril. And also interesting to note how Fed officials have started factoring in the outlook or the impact of tariffs as well. But let's bring in Ecaterina Bigos joining us this morning, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. And Ecaterina, thanks so much for joining us. I want to get started with what we're seeing there, but also those sort of broader assessments that policymakers, consumers are making around the impact for tariffs. Has that changed your thinking as well about the outlook for rate cuts next year?
It hasn't largely. I mean, obviously, as we drafted the outlook, we did take into account the risk of tariffs, and we explicitly said, and even in the last meeting, that tariffs are certainly a big uncertainty. But the scale and the timing of that will obviously drive the trajectory for the inflation and certainly the policy decisions. You say tariffs is certainly, it's a two-sided story. It can have implications on inflation, but it also can have implications on growth, which can lead in the later part of potentially 2025-26 for the Fed to pay attention more to the growth story of it. So, but of course, the timing is key here, and we need to wait for those policies to get implemented before shifting any of the forecast or any of the estimates.
Do you think, though, that sets us up for sticky inflation? And do you think we need to rethink the capacity of officials to bring inflation down to 2%?
Well, and as we went into the December meeting, I think it was very well priced in that the Fed will move an additional 25 basis points. But I think it's fair to say that they started this cycle quite aggressively with 50 basis points. And the meeting that I came pre that meeting, we said that it was not in the data. Unfortunately, arguably, the Fed did not have the data at hand to make that decision. They started that journey a little bit more aggressively. And as we move into the year end, clearly a recalibration of that trajectory was very much needed. It's still, I think we shouldn't be, should be aware that, of course, it's still very much easing bias. So the Fed is still very much easing in 2025. But the expectations of 4 cuts in 2024 was overdone, of course, on the back of the aggressive 50 basis points. And again, as the data came through and as inflation is staying sticky around 3%, particularly in core, certainly the Fed need to recalibrate that trajectory for 2025, which is the right decision.
What do you think, though, in terms of the outlook for equity market performance next year? Because really over the last few weeks, it seems like that stage is still set for US exceptionalism next year. Is that still your base case?
No, I think in the U.S. it's clear that it's staying in a positive spotlight because, again, the growth, if you look at the macro elements of it, the growth is staying resilient. Inflation is a consideration and tariffs is a consideration, but it's something that potentially will materialize a little bit more pronounced in the second part of the year. As I said, the timing and the scale of those policy will drive that outcome. Now, when you look at the drivers for the U.S. economy, certainly the fiscal support that has been injected through the Biden administration around the Inflation Reduction Act and the CHIP Act has provided that support or fiscal support to the equity market and to the broader growth. And as we go into the new administration, there's an intention to have additional pro-growth policies, which potentially will support again the equity markets. And then the other parts we have to look in terms of where the investment has been done, where the technological advancement is, and arguably U.S. is leading in that sphere. So I think there's a lot of more positive catalyst for U.S. equities, where the globe is slightly a little more uncertain, particularly around the implications of tariffs and certainly the ability of some of the central banks globally to support that growth trajectory. Because of that, I would say a Fed that is on pause will certainly limit the ability of other central banks to potentially cut rates in 2020-25.
What about beyond the US? Are you kind of reducing allocation to markets with that geopolitical risk exposure? How are you viewing this in 2025?
As we moved in 2025 and even throughout 2024, we've said that there's a lot of the rally, first of all, for 2024 is very concentrated around the tech and the broader tech cycle, which is supporting manufacturers of chips. Now, as we move in 2025, that theme is expected to be sustained. So things related to tech, automation, and the broader chip manufacturers are expected to be sustained, unless, of course, we have a realization that that theme potentially is not prevalent in 2025, which is not the case. What is important, and I think what we'll look for 2025 that is different from this year, is the broadening of the earnings recovery. And this is an expectation, particularly for US, where the pro-growth policies, a stronger, more resilient growth is expected to bring a broader recovery in earnings and certainly a rally that is not as much concentrated or not as narrow as it was in 2024, and certainly be more broad, where, of course, investors can capitalize on that. Certainly, the alpha is key, so I think we still think it's going to be an alpha market rather than a beta market, or a rally that is consistent across all industries and sectors. So we still have to be selective in terms of the areas that we deploy money into.
All right, Ecaterina, we'll have more with you in just a bit. Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. Well, let's also take a look at some of the Chinese assets. As we're about to start the trading day, we're seeing the Hang Seng looking pretty flat after quite solid gains just a day ago. It was really a tech-led rally, whether you're talking about the handover from Wall Street, but also chip and computing-related stocks in China. Seeing the A50 futures pointing to slight gains as well. We are, after all, in the window for the MLF, something we're keeping an eye on. Plenty more ahead. This is Bloomberg.
Taking a look at some of the stocks that are moving just a little bit in pre-market session so far, but a close watch on the chip makers, SMIC, Hua Hong Semi as well, because we do actually understand the Biden administration is launching an investigation into Chinese-made semiconductor chips that could lead to new tariffs. The focus on legacy ones, EV ones as well to watch BYD, XPeng, because we have seen EV makers hitting a bit of a wall in the EU, given you've got tariffs that are adding to their import costs. So BYD, for instance, fractionally under pressure. More ahead with the open of Hong Kong mainland markets. This is Bloomberg.
Welcome back. You're watching The China Show, and we're counting down to the open of markets. Of course, this has been a story, Belle, of the Chinese economic recovery really sputtering and not as solid as investors have been hoping. That's being reflected, of course, in recent share performance, and we're still watching out for any possible signs of support. We are in the window for the MLF. That's until tomorrow. But other than that, I think the PBOC has also signaled that openness to triple R, a reduction before the year is up. So among the things that we're keeping an eye on, Belle.
Yeah, that's right. I mean, certainly investors want more stimulus measures and more easing for mainland equities. But taking a look at how we're coming online this morning, because you do see the CSI 300 fairly steady, really, to start the day. But keep in mind as well what's happening across broader Asian equities today. And again, trading volumes are thin. We're pretty range-bound as well. Consumer stocks actually are leading the gains again across the region today. Quaker Motai, though, you are just seeing a little bit under pressure so far in the session. What else we're tracking is really the appetite of mainland investors for Hong Kong equities. If you take a look at Hong Kong's just opening today, yesterday we actually had mainland Chinese investors snapping up a record amount of Hong Kong stocks. So just looking at further exposure to risk assets that are listed in the city, maybe a bit of a revival of animal spirits. You do have that weakening yuan story as well, and we have seen, again, further yuan weakness overnight given the strength of the dollar. That's the state of play there for Hong Kong. Again, just some further gains, perhaps for Hang Seng Tech. You're seeing 0.3% to the upside. Chip stocks are a really key one to be watching today. We actually had reporting overnight that the Biden administration is launching an investigation into Chinese-made chips. The focus here is on legacy technology, so foundational chips that are used in things like smartphones, PCs, automobiles as well. This could end up leading to new tariffs, but again, questions over how it will be treated by the Trump team when it comes in just in a few weeks from now. But we are just seeing some gains there. Let's change on, take a look at other sectors in focus today, because we are as well keeping an eye on the EVs. And here, a little bit more pressure coming through. We had some reporting for EV sales in the EU. Of course, we have seen tariffs there adding to import costs, so about 35% more expensive given those new duties that have been levied. And we have seen sales in the EU falling as a result. But we are just seeing, again, a little bit mixed so far, but mostly some gains. Changing on, taking a look at low-altitude stocks, because here's another area that Beijing is looking to support. They're vowing deepening reform, development of the low-altitude sector, so reforming air traffic mechanisms, for instance, looking at airspace management. This is another area where China, of course, not just with drones, but other low-altitude sort of uses or functions is looking to sort of corner and develop out this market as well, Avril.
Yeah, and as we talk about the sectors that Chinese authorities might be looking to put support towards, the heart of the issue really is the property downturn. And we've seen this recent bounce in Chinese developer stocks, but that might be short-lived, with the real estate woes set to worsen before they get better. Our equity senior reporter Abhishek Vishnoi joins us now. So, Abhi, what is your sense of the outlook for the Chinese property sector? Why is it still a bearish one? And what are some of the signs of distress that have emerged recently?
Yeah, so there are signs of distress, and therefore the outlook is a bit bearish. The outlook is that the sales as well as prices would decline in 2025. The decline can be about 5 to 10 percentage points in both terms, and that's why this sector is not looking very bright. And the reason behind is fresh signs of troubles have started emerging. I mean, there are builders, property developers who have so far remained aloof of China property crisis. They have been able to navigate the market pretty nicely. There have been no default risk, but now even those developers are facing some kind of trouble. Like, for example, banking regulator has just asked insurers to report their exposure to China Wanke. One of the developers, one of the larger one, which has been able to avert any sort of default risk, but that creates a bit of a risk. That shows that there is still liquidity crisis in the market, and that's why people are a bit more worried. Among other things, there are certain developers offshore which are still facing some debt issues, like New World Development Co, and that shows there is still a lot of pain that is going to offshore developers listed in Hong Kong. So all in all, I mean, the setup is not really great for China property developers. And if you look, our reporting is largely showing that, developers which are linked to government, like China Overseas Land or China Resources Land, they are better placed than other companies. And just because by design it's a liquidity crisis, the signal for property stocks would largely come from debt market. So, bonds are still trading at distress levels. So therefore, stocks should not be trading at premium or seeing magnificent rallies. So, it feels like 2025 would be another year where the sector would try to find its footing, but it may sort of remain, in check in terms of valuations and earnings. And property is such a big part of China GDP. So overall, it starts weighing on consumption as well if it's not doing good. That means the earnings potential for consumer discretionary stocks, think about furniture or anything that goes in your home, would remain sober, not that great. And overall, the valuations for China market would also remain in check.
So it's still going to be a really fundamental issue in 2025. I mean, we're already seeing, a fifth year of this property downturn. What are you seeing potential bright spots potentially in the Chinese markets overall for 2025, though?
Yeah, so in terms of bright spots, I mean, I think the focus has to be, where China's priorities are. So, something where Xi Jinping is focusing. Property has been a very old sector in terms of bright spots within property. Government-linked stocks, big ones matter. But other than that, Xi Jinping's priorities like, chips or tech supremacy, self-reliance, these are the sectors to watch out for. And hey, if government comes out with decent stimulus on direct consumption, then maybe even consumer staples or consumer discretionary might produce some of the new winners. I mean, if it has to be a new bull market, it has to come in from newer sectors, right? Not the old ones. And property is an old sector of the old China.
So, Abhishek, I mean, it seems like there's sort of maybe at least, if not further downside, at least further volatility ahead, and investors need to hedge that risk as well. So how is that playing out in derivatives trading in Hong Kong in particular?
Yeah, so my colleague Charlotte did a wonderful story. This is the third straight year of record volumes in derivatives market in Hong Kong. And we know Hong Kong is largely a play on China's future. Now, this is a record activity where the cash prices, the spot prices on which derivatives are based, they have not moved much, right? I mean, there is some recovery, then, the rally peters out. Now, these are pointing to 2-3 things. One, this huge upsurge in, participation in our derivatives market just shows that this China story still remains a very tactical bet for a lot of investors. It also shows that a lot of hot money, like, hedge funds, are positioning in the market. And there is a tug of war going on between China's stimulus efforts, China's policy initiatives, and the problems of China's past, like policy mishaps that have happened since COVID. So there is this tug of war going on, and the backdrop is of US-China tension. So you load up on positions, you either hedge them or you take exposure via options market, minimizing your risk, and that's why activity is booming. Second structural reason, and this is a really important one, is obviously Hong Kong is a developed market, but this activity also shows that the market is maturing, and that's because weekly options contracts on single stocks have been introduced, and they've been a hit with investors. Now, if you keep US as your benchmark, more than a third of your participation would largely happen because of these smaller contracts. So that shows the maturity of the market.
Maturity of the market and part of a way to hedge the risks given the concerns about the property sector. Abhishek, thanks so much for weighing in and sharing all this analysis and reporting with us. Our equity senior reporter, Abhishek Vishnoi. Now, still with us is Ecaterina, Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. So, Ecaterina, so good to have you stay on with us. Tell us first, how big do you think this property problem is going to weigh into investing in China next year?
Well, I mean, as has been rightly said, so I mean, property is it was a large part of the GDP, and again, not just the property itself, but the broader industries that are linked to the property represented about 25% of GDP. So it's certainly important, but what has been obviously voiced out before is the importance that it has on consumer confidence. We know that a lot of the wealth is trapped into, or the household wealth is trapped into property market. So certainly a downturn in the property market creates a downside risk to consumption. And we've discussed that before, that the importance of that consumer recovery lies around the recovery of the property market, because of course the wealth creation needs to become again positive, and of course the income creation related more to job market. So the broader consumer confidence is quite subdued. So recovery in the property market will certainly have a positive catalyst on that trajectory for a consumer to continue or to start spending a little bit more rather than saving more.
So are you optimistic that we do see indeed some form of leverage and earnings recovery?
Well, the primary challenge for China property is the excess inventory that exists. We've seen various measures that were put in place to address some of the excess inventory, but those are not deemed to be sufficient to actually change the trajectory of the property market at the moment. So some downside risk is still expected. We need to see a lot more forceful measures around how do policymakers intend to remove that excess inventory. We've seen some projects were put in place to create, again, some velocity in the property market, like shanty tower renovations, which creates some positive activity. But the broader question for China property recovery is the excess inventory, and that needs to be addressed. And how the policymakers looking to address in 2025 will be key to watch for a recovery in that sector.
I mean, I think it's pretty well understood that we're looking at sort of a multi-year recovery for the property sector. But the other question, of course, is how does, in the meantime, China manage to change consumer sentiment, which is obviously so depleted? How do you think that that's going to be dealt with by stimulus measures next year?
Well, as I said, the consumer confidence is largely attached to what the property market does. Then also the job market, we've seen the unemployment increase in China. So the income creation, the wealth creation has been negative, and the income creation has been weakened by that expectations of employment, but also the weakened employment that is currently present in China. So certainly the policymakers need to focus on addressing the property market overhang and also looking at creating new jobs. And we've seen a shift on policymakers towards more services, or the intention to support a lot more recovery in services, which can create new jobs. And we've seen directed measures at specifically creating a lot more safety net related to creating more insurance policies, framework, pensions, and support to some of the household to bring that back, that safety or that social security, where the consumers can be more confident on consuming. So it is be multifaceted. So again, directed measures on supporting consumer through those policies that I've just mentioned, or property market, and certainly addressing some of the weakness in the labor market is key to reviving that consumer confidence in 2025.
We were just talking there about the trading that we're seeing in Hong Kong derivatives and the need for investors to protect themselves against further volatility ahead. What do you think will happen with Chinese equities next year? And do you think we end this time next year? Do you think markets are higher than where they are today?
I would say probably it's fairly valued to where we are in a cycle, and where the cyclical measures, or again, China is facing not just structural problems, but also cyclical problems, so related to deflation, which is linked again to that consumer confidence and the subdued CPI, but also we've seen subdued PPI, which again, as soon as China still stays in that deflationary environment, a recovery from these levels will be just an attempt. So a sustained rally needs to see, again, a consistent addressing of those structural challenges that we talked about, but also focusing on how they can address that cyclical downturn, which is related to deflation, which will, again, provide a catalyst to a sustained recovery. Until those are addressed, I think we'll see periods of volatility as policymakers come to support through various measures, come to support the market and support the consumer confidence. But again, that sustained recovery, we think, is going to take a little bit more time until we see some of those overhangs being addressed.
At the end of the day, it needs to be a consumption-led recovery. Ecaterina, great to chat. Thanks so much. Ecaterina Bigos is CIO for Asia ex-Japan Core Investments at AXA Investment Managers. Now, up ahead, Elon Musk zeroes in on the Federal Reserve, calling the agency overstaffed. Details next. This is Bloomberg.
Well, Elon Musk, who's been appointed by US President-elect Donald Trump to make the government more efficient, has called the Federal Reserve overstaffed. Our news desk editor, Jill Desis, joins us now. And Jill, I mean, I think the reporting really points this out. The Fed has less staff than central banks in Europe. I mean, where is this concern really coming from, and is it valid as well?
Yeah, that's exactly right, Ball. I think there's a couple of things to really kind of unpack here. First of all, I think we should note that with this Elon Musk tweet, he didn't really elaborate other than to just say in response to another user that the Fed was absurdly overstaffed, in his words. This, of course, kind of comes as, Elon Musk has not just been sort of a big informal advisor to President-elect Donald Trump, but he's also obviously tasked with this new Department of Government Efficiency, trying to remove some $2 trillion in spending from government agencies. All that being said, yes, I think first of all, worth pointing out that when you compare the Federal Reserve and all of its regional entities to, say, the Euro system, some other comparable institutions, the 24,000 or so staff members at the Fed actually are much smaller than those comparable institutions. So that's one point of this. The other point of it too is that when it comes to actually funding for the Fed kind of derives its own income. It's not really part of the whole congressional budgetary process. So, Elon Musk was, of course, last week very heavily involved in a lot of that, budget spending stuff that was going through Congress, obviously getting that, stopgap funding bill sort of through until they have to deal with it again in March. But this is a bit of a separate thing here. So it's not really clear if there's any kind of a mechanism for either Elon Musk or really Donald Trump to kind of interfere with the Fed here. But again, just kind of goes to show you how much, you've not just Donald Trump, but obviously in this, advisor Elon Musk have, really taken to, being provocative here and trying to shake things up with the government. What that actually results in, I guess we'll have to see what happens when Donald Trump ultimately re-enters the White House next month.
Indeed, Jill, it's quite peculiar, the outsized role that this billionaire is now playing in U.S. politics. But among the other, I suppose, vague proclamations that we've been getting out of the incoming administration, Trump also reviving interest in buying Greenland. What was that about?
Yeah, I mean, this is another one that I think can be a bit of a head scratcher. Although there's certainly something there. So Donald Trump once again raising this idea of wanting the U.S. to buy Greenland. He also raised this point back in 2019, obviously didn't really go anywhere. This time around, you had, the Denmark prime minister saying essentially like, Greenland's not for sale and will never be for sale. One thing that Donald Trump cited with his interest of Greenland was sort of the island's importance as a strategic interest for the United States. The United States does have military bases there, and obviously to rehash some well-known geography lessons here, just the location of Greenland right in between the Americas and then the Arctic Circle across from Russia, maybe is sort of a key point of interest, particularly as Russia's war in Ukraine goes on. The Denmark has said maybe they'd be interested in expanding some types of cooperation, but in terms of a sale, doesn't look likely. But I would just point out that we've seen Donald Trump many times over the last several weeks kind of ruffle some feathers among world leaders, really try to shake things up. He's made some provocative comments toward Canada, for example. We're now seeing sort of some unfolding political turmoil there. So really just kind of goes to show that Donald Trump is pretty defiant in wanting to reestablish himself among the rest of the world order. And once again, I think we'll have to see where exactly all of this goes once he re-enters the White House.
Yeah, he's ruffling feathers the world over, so to speak, Jill. Thanks so much. Our news desk editor, Jill Deeses, for us. And a look at other top headlines now. Luigi Mangione has pleaded not guilty to murder charges over the shooting of Brian Thompson, the CEO of United Health's insurance unit. Mangione appeared handcuffed in a Manhattan court to be arraigned on multiple counts, including first and second-degree murder, criminal possession of a weapon, and having a forged driver's license. His lawyer has expressed concern with the way the parallel state and federal cases were playing out, saying Mangione was being treated like a human ping pong ball. A U.S. bipartisan committee report has found what it calls substantial evidence that former Representative Matt Gaetz paid several women, including a 17-year-old girl, for sex and used illegal drugs while in Congress. The committee report accuses Gaetz of violating House rules and standards of conduct, including prostitution, statutory rape, and obstruction of Congress. Gaetz has denied all wrongdoing and dismissed the allegations. Plenty more ahead. This is Bloomberg. Welcome back. Some top corporate stories we're tracking today. MetLife has agreed to buy PineBridge Investments assets outside of China from Pacific Century Group for $800 million. The firm could fork out additional payments of $400 million subject to certain conditions, and the deal will give MetLife over $700 billion in assets under management and is part of the company's push to grow in the industry. Nippon Life Insurance says it's not done with its spending spree even after making more than $12 billion in deals this month alone. President Hiroshi Shimizu tells Bloomberg the company wants to buy a majority stake in LA-based firm TCW Group as part of its global asset management expansion.
When
we look outside of Japan, there is a market with a higher growth rate, which is the U.S. life insurance market. The U.S. has the world's largest life insurance market. Its population is growing, including immigration, and this is where innovation is happening. It is the best place for us. We only had a small business base in the U.S., so we have been looking for opportunities to build a core business base in the U.S. life insurance market for a long time.
All right, we're in holiday thin trading, but if one stock is standing out to us today, one of those is TSMC, because we've got shares rising to a record high or touching a record high, eyeing the best year for the stock since 1999. We continue to see as well the ADRs in the US trading at a significant premium. Welcome back to the China Show, taking a look at blue skies across Shanghai this morning, but also about how Chinese equities are faring half an hour into the session today. We are seeing them moving modestly higher so far, 0.6% to the upside for the CSI 300. And we are as well just keeping an eye on what's happening with trading volumes, and really they are pretty thin, Avril, at this point in time.
Yeah, though the blue sky day is reflective of the mood in equities, right? We're seeing a bit of that in the rest of the Asia-Pacific. Gains of about 1/3%. This is tracking more or less the bounce on the region's benchmark that we saw just a day ago. And indeed, this was really against the backdrop of U.S. data that's fueled those Fed rate cut bets. A bit of that follow through again from the overnight session on Wall Street. So tech is not faring that badly, but I think real estate, consumer discretionary, those are the sectors that are really outperforming today. But as you say, it's really the backdrop of thin liquidity amid the holiday season. We have a couple of other things we're keeping an eye on as well, including look at the yields in Australia. We did get the RBA minutes from its most recent meeting, keeping an eye on things in Japan as well. Bonds there a bit softer. But the focus today has been also on dollar yen, and this is against the backdrop of some pushback from the finance minister. And of course, this is something that he delivered last Friday as well, verbal intervention. But you look at the setup for the pair, it's really that dovish BOJ versus the hawkish Federal Reserve that's not, doing it any favors. And you think about how in swaps pricing as well, it's really not enough to get the yen bulls excited. I think in the January meeting, the odds are less than 50% that we see a hike from the BOJ, and then you look into March, even less. So that's the setup that we have as well. Keeping a close watch on any actual intervention. Suddenly there's the risk of that. Keeping a close watch on developments in Japan. Belle.
Yeah, I mean, certainly we have had that sort of note of caution from Ueda, but let's also take a look at how Nippon Steel's faring. We're actually 1.5% in the green today, despite these headlines that we're also getting on the outlook for its proposed acquisition of US Steel, because we understand that President Biden is set to make a final decision on that sale. That's after a national security panel was deadlocked on the review of it. Let's get more with our Tokyo Bureau Chief, Isabel Reynolds, joining us. And Isabel, I mean, we've had the previous reporting that Biden was likely to oppose this, but is there any chance of sort of a last-minute change of heart?
Right. Well, at the moment, the whole situation is playing out exactly as our colleagues Joe Doe and Josh Wingrove reported approximately 2 weeks ago. As you say, the panel has been deadlocked, and it's now deferred the decision to President Biden, which could be one of the sort of final momentous decisions of his presidency. He has 15 days to make that final decision after the decision was deferred to him yesterday. The report came to him yesterday. And as far as we know from our reporting from the US, there is no change at the moment. He is set to go ahead and block the decision. That means it doesn't look good for the deal going ahead, of course, because as we know, former President Trump, or President Trump-to-be, is also opposed to the deal. So this opposition is coming across the political spectrum. And it simply doesn't have enough backers, I think, in the US to make it a very viable proposition at the moment.
Talk to us, Isabel, about the nuances on the Japanese side, though. And, do we have any sense of whether Nippon Steel would have the sort of impetus to get it over the line in any way?
Right, and all we're hearing from the Japanese side at the moment is that obviously Nippon Steel is extremely unhappy with this situation, and there have been sort of veiled threats to push ahead with legal action against any such decision. Of course, that hasn't happened yet, so we don't want to get ahead of ourselves. And of course, I'm not a legal expert, so I have no idea if that has any sort of hope of changing the decision in the end. But I think on the Japanese side, it's a much broader unhappiness with the decision. It goes much beyond Nippon Steel. Japan, obviously, the US is its biggest ally in the whole world, or its only ally in some senses. And any decision that sort of throws any doubt on that security alliance and implies that a relationship with Japan is a security threat is something that Japan really doesn't like. So although they have been very circumspect about commenting on this deal in official circles in public, going forward, if this decision becomes sort of public on the US side, I think we could see some reaction from Japan on that front, showing their unhappiness.
Yeah, and indeed, just on that point, I mean, the companies were arguing that this deal would be sort of creating a new conglomerate of sorts to try and compete with China, and that's, of course, the focus of the incoming Trump administration. It has been the focus of the Biden administration, these tensions between the US and China. Do you see that factoring, again, going back to whether we see any sort of changes of opinion on this, do you see that possibly factoring in at all?
Well, obviously it's impossible to say what President Trump will decide in the end. He's been very public about his opposition to the deal and said that there are other ways of sort of making US Steel more viable as a company, especially through his favorite method of tariffs, of course. But you can't say never in these situations. He can be quite unpredictable in the way he reacts to things. So I guess we can't rule it out completely, but I think he sees this as a great sort of golden US asset, and for him, apparently it seems like something that he's not prepared to see taken over by any foreign country, even if it's a country that he sees, I think even he sees as relatively friendly.
Yeah, Isabel, we're really waiting with bated breath with some details on potentially what Trump's policies might mean for these companies and relations as well. Isabel Reynolds in Tokyo, thanks so much. And of course, Belle, as we've been, discussing, it's really about how the US-China relationship is potentially going to shape trading, not just what we see with the Asian giant, but also against the backdrop of potentially new flare-ups with other countries. You think about the trade surpluses that the US or some of these Asian nations have with the US, I should say. Does this sort of paint a target on their backs and enhance the risk maybe as we look into 2025? So for more on what traders are looking out for in the meantime, this Christmas Eve, our Bloomberg M Life strategist, Mary Nicola, joins us now. Mary, brushing aside for now what the risks might hold for 2025, what do you think the rest of the year's trading is going to be, because we have seen stock markets kind of shrugging off that lack of consumer confidence, a bit of a hawkish Federal Reserve, to say the least. What is the key driver you think going to be?
Well, first and foremost, it's Christmas Eve. It's time for festive cheer, and we're seeing it in equity markets. And I think that's likely to stay because no one's going to put on any new positions at this point. There's going to be this holiday lull, liquidity's thin. So the trend is your friend at this point. So a lot of what we saw initially is likely to stay in place. So that means, strong dollar, equity rally. That's all likely to just continue into the end of the year. Probably when we come back on the 6th of January and that first week back in January, the first work week, that's when you'll see traders really positioning. But still, there's a lot of uncertainty going into 2025 when it comes to about Trump's policies and what the new administration holds, not only for the U.S., but for the rest of the region.
So for the rest of the region, what is stock trading going to look like? I mean, we've been talking about U.S. exceptionalism, but are we going to see that trickle through into equities? And how much trouble is that going to mean for fixed income, bonds, for FX as well, that don't seem to be, in party mode along with stocks? Yeah,
I think going into 2025 and now, especially a lot of what's happening in the region is very much focused on how the dollar layout and how the dollar is unfolding. And of course, we know that the Fed has made it very clear, and the dichotomy between the Fed and other central banks is just becoming wider and wider. So today, for example, we saw that the RBA minutes was talking about more in terms of becoming a little bit more dovish, and that's quite different from the guarded stance that we've seen over the past year with the RBA. And the disparity that we're seeing between the BOJ and the Fed, the Fed and the RBA, this is all becoming wider and wider, and it's going to have much of a stronger impact on FX, on fixed income, whereas equity markets, they might benefit at least from the Santa rally, and then going into next year, just from what's happening in U.S. tech, filters onto the tech stocks here in Asia. So there's going to be that disparity between the two, and a lot of it is because the bonds and the currencies are still going to take the lead from the dollar.
And so, Mary, how long do you sort of see that dynamic persisting for? Because dollar strength seems to be remaining intact at least for the next few weeks.
Yeah, at the very least, I think, in terms of the dollar is just, the Fed has just reconfirmed the dollars, that the focus is going to be on the dollar, that the dollar strength persists. And of course, when you have the Chinese yuan also weakening at the same time, it puts even more concern in terms of how the rest of the region and the currencies unfold. So what I think we see is even heading into next year, it's going to really be a focus on the dollar unless we get some of the concerns about trade policy. So the likelihood of fiscal profligacy comes to the fore. That will have an impact on treasuries, but could very well impact the dollar as well, where investors become uncertain in terms of what the dollar trajectory holds. So I think in the meantime, the Fed is going to just essentially rule the narrative heading into next year, especially after inauguration and how the Trump administration unfolds. That's when we can see the tide turning a little bit for the dollar. But even then, the U.S. exceptionalism theme is still going to hold. So it still gives the dollar an edge, and we still haven't seen that turning point yet come through for the dollar.
All about the greenback, Mary. Thanks so much on that note, and Merry Christmas as well. Thanks for coming in and sharing your thoughts with us. Mary Nicola of the MLive team. Now coming up, we talk crypto with Token Bay Capital amid optimism of a friendlier regulatory environment under Donald Trump's incoming administration. This is Bloomberg. Well,
President Biden's administration is launching an investigation into Chinese-made semiconductor chips. It's a move that could lead to new tariffs. We're not really seeing that having much of a bearing so far on the trading activity or on the outlook for individual chip stocks. But let's get more with our China correspondent, Min Lo. And Min, what's exactly new about this investigation? Because we actually already have seen a bit of pressure, or at least, policies addressing foundational chips in China.
Yeah, we previously reported this. This is basically a confirmation of our scoop that that Bloomberg reported earlier. President Biden's administration is now investigating these legacy chips that are being sold by China to the U.S., and it could pave the way for more tariffs, higher tariffs, or perhaps import restrictions at the end of this investigation, which could possibly take between 6 to 12 months, by which time, of course, President Biden would have already stepped down. So President-elect Trump will be the one who has the power to decide what to do with the outcome of that investigation. And again, this applies to the legacy chips, the older generation of technology. That is something that China has been doubling down on. It's pretty much what they have been limited to producing, given the tightened access to advanced semiconductors and advanced equipments from the U.S. and other countries. And this, by the way, is on top of expanded tariffs. Washington already earlier this year increased the tariffs on these Chinese legacy chips from 25% to 50% by next year. And the argument here is that U.S. officials are saying that these measures may not be enough to stem the flow of artificially cheap chips from China, and they could pose a national security threat to the U.S. as well.
I mean, it's interesting because you kind of think, well, these are subsidies, yes, maybe China is supporting the sector, but the US has also supported its own US companies in at least advanced semiconductors, and we see that through the US CHIPS Act. So what's China saying about this?
Exactly. That was exactly what China was saying, that there is a double standard being applied here. The Chinese Commerce Ministry pointing out that the U.S. is also supporting its own chips industry with the Chips and Science Act, pouring in huge sums of subsidies into the sector. And not only that, it's also saying that the U.S. is exaggerating the threat, given that Chinese chips make up only 1.3% of the U.S. market share, while U.S. companies make up about half of global market share. So you got to wonder whether this investigation is politically motivated, or is it really going to pose that much of a national security threat to the U.S. here? And of course, China is saying that, it's calling on the U.S. to correct its, quote, erroneous actions here. And China says it will take every necessary action to protect its rights and interests.
That's our China correspondent, Min Lo there. And taking a look as well at what's coming up, because Hong Kong's finance secretary says the city is prepared to weather US President-elect Donald Trump's protectionist policies. Paul Chan told us exclusively that the business hub's economy is stabilising.
There are challenges and opportunities. Yes, what you have put, but on the other hand, we have seen the business sector responding. Say, for example, redistributing their industry chain. So we position ourselves as the supply chain management center, and also providing consulting services for these companies when they want to reallocate their supply chain in the region and try to consolidate their positions and open up new markets.
How much, though, could this? You have to have contingency plans. What levers do you have to enact if he follows through on what he is going to say he's going to do? I'm talking about Donald Trump, of course. You've already said that the outlook for GDP growth, I think the previous forecast for full-year growth would be between 2.5% to 3.5%, yeah. But you're now saying at the lower end. How do you protect that lower end of the band of growth?
Well, interest rate is coming down, which is good for business, good for the asset sector. And at the same time, our efforts in attracting strategic enterprises and talents are bearing fruits. At the moment, at least 100 strategic enterprises are coming. In the next couple of years, investing over 40 billion to 50 billion Hong Kong dollar, creating 17,000 quality jobs. We have approved those talents under the various schemes. About 230,000, and about 160,000 have already arrived in Hong Kong. These are the drivers, the impetus to help us grow our economy. And these talents are in the sectors that we need. So it would be very important for us to embrace them and to work together to grow ourselves, not just in the financial services sector, but also in the technology and innovation.
One of the great strengths has been the consistency of the dollar peg, obviously. There has been chatter out of Washington that perhaps the new president-elect would like to see less independence from the U.S. Fed. Is there any scenario that you would be considerably worried because of the dollar peg and essentially de facto central bank is the Fed?
Well, the pegged exchange rate system works very well for Hong Kong. We have no intention at all to change that. We have experienced different challenges over the past few years, so we have plans in hand to respond to any circumstances.
That was the Hong Kong Financial Secretary Paul Chan speaking exclusively with our Chief North Asia correspondent Stephen Engel. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live programming. Check it out at TV Go. This is Bloomberg. Welcome back to the China Show. Some of the top stories that we're following this morning. And MetLife has agreed to buy PineBridge Investments assets outside of China from Pacific Century Group for $800 million. The firm could fork out an additional payment of $400 million subject to certain conditions. The deal will give MetLife over $700 billion in assets under management and is part of the company's push to grow in the industry. Nippon Life Insurance says it's not done with its spending spree, even after making more than $12 billion in deals this month alone. President Hiroshi Shimizu tells Bloomberg the company wants to buy a majority stake in LA-based firm TCW Group as part of its global asset management expansion. Nippon Life and other Japanese financial firms are ramping up overseas to overcome Japan's aging and shrinking population.
When we look outside of Japan, there is a market with a higher growth rate, which is the U.S. life insurance market. The U.S. has the world's largest life insurance market. Its population is growing, including immigration, and this is where innovation is happening. It is the best place for us. We only had a small business base in the U.S., so we have been looking for opportunities to build a core business base in the U.S. life insurance market for a long time.
Xerox has agreed to buy printer maker Lexmark in a deal valued at $1.5 billion. Xerox shares jumped in New York on the news. The deal includes debt and other liabilities that Xerox will take on from the current owners as a group of Asian investors. Xerox will cut its dividend in half to help finance the takeover, which is expected to close in the second half of next year. Telegram CEO Pavel Durov says the social media app is profitable for the first time after paying down about $2 billion in debt. Durov says revenue topped $1 billion this year and it has more than $500 million in cash reserves, not including crypto assets. Telegram is under growing criticism from governments over the spread of illegal content and misinformation. Taking a look at markets this morning and really, I mean, it's fairly quiet so far, but there are some stocks we're tracking in particular. Of course, Honda, Nissan, that integration is really capturing a lot of the attention this morning. But in aggregate, this is essentially a tentative agreement to set up a joint holding company. Honda definitely takes the lead on this one. They're also nominating a majority of the directors, but it is aiming to create one of the world's largest car makers and then help them take on not just Toyota. You can see at the bottom there, trading still fairly flat so far, but also taking on the Chinese automakers. In terms of the reaction to this, well, Moody's is out there with a report and they're saying that this integration is overall credit positive, if it is executed positively or successfully. Some of the other stocks that we're tracking so far this morning, TSMC, we did actually earlier see that stock looking at a fresh record high. We had that last record back in November of this year. Taking a look at the SINS function, and it is now trading at its high since November of this year, but essentially eyeing the best year for the stock since 1999. You're looking at gains of more than 80% over the course of 2024, but it is still seen by a lot of investors as the best way to get exposure to AI generally. What's interesting to note as well is when you take a look at what's happening with ADRs of TSMC, and these are trading at a significant premium, actually the biggest premium we've seen for the stock in 2 months. TSMC's shares in the US cost almost 25% more than they do in Taipei, but it is a sign that, again, global investors, they're still willing to pay up for names that are exposed to the AI boom. Leaving that there, we are going to get more details just ahead as well of what's happening with the Nippon Steel deal. Just some lines coming out now is that they're saying that CFIUS says that they referred the US decision to Biden. They've failed to reach a consensus. More details ahead. It's 11:29 a.m. in Tokyo this morning. Japanese traders just about to go into their lunch breaks. Look, I mean, it's a very quiet session today. Of course, you've got a lot of traders that are looking ahead to their holiday breaks, but a lot of the action is happening in Tokyo. You've got not just what's happening with Nissan and Honda, but also what's happening with Nippon Steel. And it has been sort of the debate around what CFIUS was going to be saying. It does seem like there's deadlock. This is the agency tasked with taking a look at whether there's any sort of conflicts with a proposed takeover of US Steel by Nippon Steel. Essentially, what Nippon Steel is now saying is that CFIUS has said that they've failed to reach a consensus of that. It means that the decision is now referred to Biden, and our reporting and what we're hearing from sources is that Biden is likely to block this acquisition. In terms of the market reaction, Nippon Steel hasn't really been moving too much throughout the session. It's been in the green just a little bit throughout the morning day so far, but that is what you're seeing for Japanese equities there, keeping a close watch as well on what's happening with the Japanese yen, because we have seen policymakers this morning pushing back on yen weakness against the greenback. But dollar strength, of course, taking a look at broader markets, has been sort of the major market dynamic overnight. We saw it rising again for another session today, gaining across currencies in the G10 space. Market reaction so far today, you've got Asian equities just moving a little bit higher. US futures are looking pretty flat today. Overnight, we saw tech leading the gains. Today, I mean, it's sort of at the midpoint. It's really not standing out too much except for shares of TSMC. We were also taking note of earlier, given you've got TSMC that earlier hit a fresh record. It's now trading at the highest in about a month for that stock as well. And as well to note, ADRs for TSMC are still trading at a significant premium, the biggest premium we've seen going back 2 months. Keeping an eye on what's happening with crypto as well, given that you did see prices again a little bit under pressure, and actually you've peeled back for some recent highs of around that 104,000 mark, and now trading at around 94,000. So the momentum sort of is ebbing a little bit as we head into the last stretch of what's been a very record year. But taking it back closer to what we see sort of in this part of the world, and it's that continuing race for who's going to be the big crypto hub for Asia. And Singapore is forging ahead with its efforts to formulate that lead in the race against the rival hub, Hong Kong, that does seem to be struggling to gain traction. So let's get more with our cryptocurrency reporter, Suvashri Ghosh, joining us this morning. And Suva, look, it's neck and neck. So why is Singapore sort of seeming to get a bit of a lead right now?
Actually, yeah, Annabelle, it's really neck and neck among the two, close rivals in this part of the world. Singapore has taken a little bit of a march ahead, especially given that it has been more proactive with with the licensing speed to cryptocurrency exchanges and companies over here. We've seen that, about 13 licenses were given out to companies in 2024 by Singapore, which is almost more than double, actually. Last year, it was in 2023, it was 6. And so the pace of licensing has been increasing in 2024 by the Monetary Authority of Singapore. We have also seen a little bit of more progress in the blockchain initiatives by the MAS, the Monetary Authority of Singapore. Like, for example, there is a global layer 1, which is intersection of different banks and institutions to build, blockchains that will talk to each other. So that has been taken a little bit ahead as well in this year. Singapore has also come out with some of the consumer protection rules, tightening the rules. Of course, I have to add that Singapore is pretty cautious about cautioning its retail investors to not dabble in cryptocurrencies. It has banned public advertisements by cryptocurrency companies. So it has a very balanced approach. However, Hong Kong has been also making progress, to be sure about this, that they had come out with the exchange-traded funds for Bitcoin and Ethereum. We haven't seen a lot of uptick in the flows into those funds compared to maybe US, which is like we are seeing a lot of flows there, though in the last week it has been a little bit of an outflow. Overall, Hong Kong has been a little less in terms of the pace, it has been slower than Singapore in extending new licenses. We saw recently, last week itself, 4 new licenses were given to the crypto exchanges in Hong Kong. Still a little slower than Singapore. Over and over, it is, as you rightly said, a neck-to-neck, kind of a race. But we are seeing Hong Kong being a little more tighter tighter and conservative in terms of, actually letting companies start their businesses in Hong Kong, whereas in Singapore it has been slightly, I would say, more flexible.
Yeah, I mean, I think if you look at the list of who's deemed to be licensed in Hong Kong, there's at least a dozen that haven't got that sort of full conversion yet. But you mentioned that sort of consumer protection that we see in Singapore and Hong Kong, and these are both sort of stand out on a global stage for that. How do you think then about the race of these 2 Asian hubs, also maybe Tokyo or Seoul, versus the US, and who can actually become the most dominant player in this space?
A very, very interesting and good question, Annabelle. At a time when President-elect Donald Trump we know is a big crypto supporter, and we are seeing a lot of interest in crypto in the US, which is the largest cryptocurrency market in the world. In that situation where next year we are going to see a lot of interest and regulation coming up in cryptocurrencies in US, Asia might be also getting a lot of interest, because especially that this part of the world has seen a large amount of crypto regulation, be it Japan, as you rightly said, Hong Kong, Singapore, even South Korea. A lot of other countries are coming up with their regulation. So when there is a regulation, there will be people gravitating to those countries just because they know that they will not be going into jail or witch hunted for doing something which is not permissible. So that leads to overall growth in the cryptocurrency markets in Asia as well, even if US is going to be seeing a surge going ahead in this next year.
That was our Bloomberg crypto reporter there, Suva Ghosh in Singapore. And let's bring in Lucy Gazmararian, founder and managing partner at Web3 and crypto-focused VC fund Token Bay Capital. Lucy, thanks so much for joining us. Early for you as well over in the Middle East. But want to get your thoughts on the trading activity we've seen around Bitcoin of late, because it seems like maybe some of the news and the expectations around what Trump could mean for crypto have been priced in. What do you think about sort of the outlook over the coming few months?
So we've had a stellar run with Bitcoin this year. Just a few months I was speaking about the price, and we were sort of concerned that it had dropped around 50K, and now obviously we've gone past 100K, and we've seen all new all-time highs in 2025. So a lot of anticipation with the Trump administration, with this talk of a Bitcoin strategic reserve, has really sort of given more impetus to this asset. But, there's still a way to go. If you look at past cycles, we are actually not at the end of this current bull market. So although to many, now that we've hit the 100K mark, it seems, wow, Bitcoin is very frothy, it's very toppy. We've sort of had some voices coming out to say, is it time to short Bitcoin? But actually, if you look at historical cycles, we could see Bitcoin going to sort of 200K next year. And that's based on the premise that the overall crypto market cap will likely grow into sort of 10 trillion and above. Currently, it sits at around 3.5 trillion. So if Bitcoin maintains dominance of around 40% of the overall crypto market cap, it's really very likely that it could push into the 200K territory. And it's not just about the Bitcoin strategic reserve. Obviously, there are other tailwinds for Bitcoin. We've got the ETFs that are in place. We've got big financial asset allocators like BlackRock coming out and advising investors to allocate 2% of their overall portfolio to Bitcoin. So there's really a lot of tailwinds for Bitcoin's price. So it looks set to go higher from here, even though there has been a small pullback, I would say, and really centered around Jerome Powell's comments, potential for a more hawkish Fed, potential fears of inflation. But Bitcoin should be on a pretty strong trajectory given how pro-crypto Trump's administration is.
What's the chance, though, what's the risk, say, of that Bitcoin reserve not getting through Congress? And if we don't see all of these policies that are enacted, do you think that then that, as a result, dents the appeal and dents that call for 200K?
I mean, the US government already is a holder of Bitcoin, so it's sort of how they reorganize those holdings. So that's one thing. They can still come out with very positive headlines that they're creating or starting to create a strategic reserve. And then at the same time, they need to really start pushing the bill through Congress, because to buy Bitcoin to fund a strategic reserve will require a law change. Jerome Powell actually just came out and said, the Fed cannot hold Bitcoin. It is not legally allowed to do so. So it does require a change in the law that could take longer. But there's a lot of rhetoric. There's a lot of, pro-crypto comments that can be made by a pro-crypto administration that would still support the Bitcoin price. And even if it takes a while for the US to push new legislation through Congress with regards to the Bitcoin strategic reserves, it's going to spur other nation states to really take a look at their framework and whether they should also be adding to Bitcoin reserves and making it a national reserve asset. So it's really, given the level, how high level these discussions are, it's really likely to set off a chain reaction among nation states globally.
It's something sort of stood out to me this year, aside from the optimism around Bitcoin generally, it's also just been the sheer amount of new tokens that have been issued. Do you think that trend stays intact, and what exactly does that signal to you?
There is an enormous proliferation of tokens out there, which are called altcoins, so alternative tokens to Bitcoin, which is the original token. But that's kind of a feature of a permissionless blockchain ecosystem. The fact that anyone can access these tools, anyone can now launch tokens themselves within a few clicks. So that's going to lead to a lot of sort of spam tokens and not tokens that really represent decentralized business models and credible use cases, which do exist amongst all the thousands of sort of, less useful tokens out there. The other interesting trend that we're seeing in 2025 is really how AI is coming into the crypto and blockchain ecosystem. And that's also turbocharging sort of token issuance by actual AI agents. So there are a lot of tokens out there. It does require looking through the noise, sifting through the different promises of different teams and tokens out there and selecting ones that really represent something meaningful and business models with utility in a decentralized framework.
What do you think about the reputation of crypto? Because I think, these ICOs or new tokens that have been issued and the chance for pump and dump schemes or for people to be really burnt in this space is still there. But at the same time, you've also got that sort of changing perception or demand from institutional investors. So how does that sort of also kind of shake out over the coming 12 months?
I mean, there's a hope that now there's sort of more acceptance of this asset class in the US. We're going to get them sort of leading with regulation and really clarifying this. There are a lot of scams out there. It's very easy to scam consumers online. It's still pretty anonymous out there. You know, there's teams that will launch a token and you don't even know their name. So that is still happening, and it does give crypto a bad name. But amongst those sort of more scam-like projects are actually very credible projects with teams that are building and raising from sort of institutional investors. There is a focus on really, you know, looking for these talented teams that are building. But consumer protection for many still needs regulation. We need more clarity around the issuance of tokens so that if you are going to go and launch a token in 3 clicks, you know, that there are going to be consequences if you're scamming investors or consumers.
At the VC level, what are you seeing in terms of the amount of funding, and are you seeing any sort of frothiness around certain projects in crypto as well?
I think, happily, the frothiness has migrated to the AI sector. So I think it's safe to say that the frothy valuations are now in the AI space, which is great for the crypto space. It's become a lot more, I would say, realistic expectations. And no, I wouldn't say that it's frothy in the crypto markets currently. There's less funding than we saw at the peak in 2021. That was really sort of the frothy peak of the crypto and blockchain markets. That has not come back yet, but we may see a return of that if the second leg of this bull market plays out as expected, and we see a big upsurge in the overall crypto market cap in 2025. And with that, you know, a big jump up in the valuation of many of the altcoins out there.
Right, that's Lucy there, Lucy Gazmararian, founder and managing partner at Token Bay Capital, and I hope to see you in Hong Kong next year. But still ahead, Chinese plane maker Comac goes on the charm offensive as it looks to secure its first international customers for its C919 jet. That's next, and this is Bloomberg. Sources say Chinese plane maker Comac is in talks with airlines in Indonesia, Kazakhstan and Cambodia to secure its first international customers for its C919 jet. Our transport reporter Danny Lee is with us again. And Danny, I mean, it seems like this would be, of course, a really big coup for the plane maker, but they do need to offer some generous incentives to also get those deals across the line.
Yeah, as you said, that you know, China's answer to Boeing and Airbus is very much on the hunt to secure its first international order for the C919 jet. And you know, as our reporting shows, it's been Comac has been hunting airlines and even governments in Indonesia, Kazakhstan, and Cambodia. And you know, the confidence it has in securing its first marquee order for in terms of international order is very high here. And you know, given the lengths it is going to try and get an order over the line here, and you know, particularly as our reporting shows, shedding light on the fact that it's willing to offer generous financing terms, and even going as far as potentially offering help to finance airport construction. Clearly, it's pulling out all the stops here. And I think one of the most exciting countries that Comac has been viewing is Indonesia. It's been talking to the Indonesian government extensively, and also the prospect of securing an order down the line with the state carrier, the loss-making state carrier Garuda Indonesia, who really needs new aircraft, potentially up to 70 new aircraft to help focus on its turnaround and future expansion and revival. Comac could play a part of that.
How many jets, though, do you think that they can produce? Because, I mean, yes, there's the order backlog that we see for Boeing and Airbus, but how much can Comac actually plug that gap? How quickly? And does it have the capacity to also, you know, service those aircraft, for instance, outside of China?
Yeah, there are two kind of dynamics here that Comac is going to have to try and weigh up here. The fact that you know, it's very much dependent on the kind of supplies of engines and other parts that it will need, not necessarily getting them at the pace it wants, but it is starting to steadily increase its output of aircraft. Over a dozen this year, which doesn't sound like a lot, but it's a start to try and chip away at its now backlog of still around, reportedly around 1,000 jets. But with the 300 orders it secured this year alone is a good start. But then the need of maintaining those aircraft around the world with spare parts and whatnot, that is a challenge, and that's something that even GE, which supplies the engines to Comac C919 jet, they're saying that it's going to take a lot of time to try and scale up Comac's C919 jet to a level of maturity that can be equivalent to Boeing and Airbus. So, yeah, clearly lots of challenges ahead, but the confidence that Comac has in supplying more of these jets around the world, not just in China, is quite high here.
It's interesting because you think about also, we've already got the concerns around China's dominance in EVs, for instance, or EV batteries, solar panels, and you're already seeing that pushback from governments and businesses abroad. How is Boeing and how are Airbus likely to respond here?
So Boeing and Airbus do have a kind of more difficult position when you look at the makeup of the aviation and landscape right now. We've heard so many times the supply chain being so strained. So even for Boeing and Airbus, they are struggling to supply many more jets that airlines will want. And this is why, in many ways, the likes of Indonesia, the airlines are turning to, or even just talking to Comac to see what they could offer, because frankly, with Boeing and Airbus sold out of their most popular jets until the end of the decade, there is a chance here for Comac to try and have an opening and have a chance at booking more orders and taking more orders away from potentially Airbus and Boeing at the same time. So there is a chance for Comac to get in here, but clearly the pricing factor and the prestige that Airbus and Boeing have, they will be able to try and put up a strong defense against someone like China in the years to come.
That was our transport reporter, Danny Lee there. And on that point of China and their EVs as well, we've actually been tracking those throughout the session because we actually had some data coming in overnight, the sales of China's EV makers in the EU. And we actually have started to see that having a blunt on those buying or purchases of China-made EVs, given new levies have been imposed. So the EU putting tariffs of up to 35% on Chinese-made EVs. It is affecting companies like BYD and MG. MG's been hit the hardest with tariffs there, but we are seeing less vehicle registrations from Chinese EVs in the EU, not having any sort of bearing so far on markets though today, because you are seeing the likes of BYD trading 2.6% in the green. We'll have more ahead. This is Bloomberg. A quick look at some of the top global headlines now. And French President Emmanuel Macron has picked Eric Lombard to be the country's finance minister. Lombard is an experienced finance professional and he faces the chance of repairing France's finances after the collapse of the previous administration over next year's budget. The country has been in political turmoil since June, when Macron dissolved parliament and called for elections. Former US President Bill Clinton has been hospitalized for observation after developing a fever. A spokesperson says the 78-year-old remains in good spirits. The former president was active on this year's presidential campaign trail. He underwent quadruple bypass surgery back in 2004. Taking a look at how markets are faring so far, and we've been discussing throughout the session really that traders already seem to be sort of on their holiday breaks, and if you need any sort of indication of that, of course, you can always check trading volumes, and today we're around 15% lower than where we'd typically be on a 3-week moving average basis, though we do see stocks continuing to push a bit higher, gains of 1/3% so far for the Asian benchmark. Again, those trading volumes there visualized on your screens, but more ahead. This is Bloomberg.